And one more time. We're live. Good morning to everybody who's joining us today on Behind the Markets. Welcome to the Wealth Wednesday edition, 28th of June. We're getting close to the end of the first half of the year, 2023. Vernon, how has this first half been for you, my brother? How has it been for you personally before we get into the markets?
So the first half has really been momentous. It's been rather instrumental, I think, in quite a number of ways, and of course, just understanding how things, of course, took off on a very interesting note, and just concluding the year 2022. I think things have been moving in a good direction, and I understand people will say, well, economically, there's been this, hiking prices, dollar appreciation, depreciation, but I think ultimately, from how I projected things, I think we are doing way much better. How's been your first
Well,
quarter?
my first two quarters have been interesting. Obviously, it's not always to task. I always believe that my third quarter is always my best performing one. The first one is momentum building. Second one is where I'm building up the pace. Third one is where I really nail things now. It's where I really go for things. I've always found a lot more success somewhere between July and October. That's usually where I start to hit the dots on the board very well. But generally, I would say to people, focus on you, people. Focus on you and what's happening in your spectrum before you start to broaden it out there. So today, people are going to be talking about three main things today. First thing we're going to be going through is the markets generally. Then we're going to be going through our deep dive. Today, we're going to do a special edition as the ministerial statement came out yesterday on the debt deal, on what the specifics are, and what it means. And I'm going to take you through an in-depth analysis on that, a few deep dive stories, and then we're going to talk about risk-balanced portfolios, balancing your risk out. The importance of making sure that as your portfolio grows, you want to start getting into that. So to kick things off, Vernon, let's get into the markets today, 28th of June. Wealth Wednesday for everybody who's joining us today. Welcome aboard the train. It is time to get started. So today on Wealth Wednesday, as you said, we are talking all things to do with with the markets. We did see that the kwacha got weaker yesterday by 0.72%. We're back at 17.2793. We haven't yet gotten the mega flows, consistent flows that are offsetting outflows of dollars in our markets. So we're not yet seeing that consistent inflow that's coming in, and also the recovery of our exports. We're still weak in terms of exports. I think that's the one thing we're not paying attention to. And we are in a slight bit of an export, for lack of a better word, export recession, especially in the copper area as well. But we are seeing a weak currency, 17.2793, down 0.72%. But on the week, the dollar is down 1.74%, 30 days down 11.26%, and year to date down 4.52%. It is in a selling pattern still, so you really don't want to get involved in this battle. On the Lusaka All Share Securities Index, we are seeing the All Share Index was down 0.18% as there was a battle between two major stocks yesterday. Sorry, I think we're getting a little bit of feedback, gentlemen. There's a battle between two major stocks yesterday. Though we saw the 7-day sell-off was about 0.11%, but on the 30 days, the All Share Index is up 0.45%, year to date up 12.1%. So one of the things we're also seeing as well is that the bond index was up 0.06% yesterday, but down 1.23% in dollars as interest rates slowly came back down below the 24.14 mark, which we did see them hold at yesterday. Now, the other part that we're seeing on the markets, we did see that the rand was up 1.36%, but still below the kwacha. We still have a stronger kwacha than rand, down 12.37% year to date, down on the week, down on the month. So we do have a bit of cross-border trading hope that cross-border traders' products will not come in too expensive. And year to date, as I said, 12.37%, but still 70% of the days we have seen the rand moving up. So it's just been a huge monumental movement, which have wiped out gains and then regained, and then wiped out gains and regained. So that's been the real seesaw effect happening with the South African rand, which, by the way, affects our exports, affects our inflation and our goods and services sectors. We did see, as I said, bonds are up 13.05% year to date, while in dollars they're up 18.29% year to date. and interest rates are up 0.49%. So we're getting a little bit of a mixed picture when it comes to the bond market. Commodities, in terms of yesterday, are down 0.3% on copper on weak Chinese industrial data yesterday, with Brent crude also down 0.4% on weak industrial data and rate hiking fears, and gold also down 0.56% on rate hiking fears. On the cryptocurrency market, we have seen Bitcoin still maintaining that $30,000 mark. So we're still seeing Bitcoin in Kwacha up, still up 1.2% and still at 5.28. 528,278 kwacha, up 75.75%. Remember, people, cryptocurrency is extremely risky. Do not just look at the rate of return. I'm going to be talking about that yesterday. Ethereum up 49.1% yesterday, but down 0.2% yesterday. And gold and kwacha up 0.16% as the dollar rise was offset by the kwacha the power of the dollar was offset by the dip in the price of gold in dollars. So this is our broad market mix that we're looking at here: 13.1% on bonds, 12.1% on stocks, while we're seeing dollars down, gold slightly up, and cryptocurrency still up the highest, but mainly due to the Q1 rally that we saw. If we're looking at oil prices yesterday, well, we are expecting only a 28 Ngwe movement. This is as of now. So we're somewhere between a 40 to 28 Ngwe movement. We're not expecting much in terms of the market so far. So probably expecting that the ERB will probably hold prices still at the end of this month. I'm not seeing any downward pressure, but I'm also not seeing much on the upward pressure perspective, as the currency has performed enough to try and work in line with the global Brent prices coming down a little bit. Now, in terms of our four horsemen, which is our final part of this session, is that we saw Canadian CPIs decline to 3.4%, but Japanese CPIs rose to 3.1%. US crude inventories fell by 2.5 million barrels. That could actually push prices up later. Italian 2-year bonds auctioned higher, while 5-year bonds auctioned above 4% in the US yesterday. US and Italian consumer confidence did rise yesterday, while Italian business confidence came down. But in the industrial sector, we saw US month-on-month building permits up, US housing prices up, and new home sales also rose to 12% in the month. Headline durable goods sales also rose by 1.7%, but unfortunately, Chinese industrial profits declined by 18%. This was bad news on our major front. But we have seen that there is a little bit of a mixed bag of news, mostly leaning towards a negative. Inflation is still sticky, but it's not. It's still on the way downwards. Interest rates are starting to rise still in certain areas, but we're seeing more of the longer term interest rates rising. We're seeing a mixed bag of consumer confidence and business confidence, but we are getting industrial data where the housing sector is looking strong in America, but the industrial sector in China is looking weak. So that is putting copper in a mixed situation because both are big customers of what copper is globally. That, Vernon, is our roundup of how the markets are doing. We're going to be talking about Debt Deal Done, the special issue on the other side of the break. See you all that side. Sorry, Vernon. I think your microphone maybe. I don't know if your mic is on mute, but we can't hear you. Okay. Yeah, as we wait for Vernon to get back with us, we're still unable to hear him. Welcome back to the second half of the show. I Yeah, still nothing. So yeah, welcome back to the second half of the show. We are getting back into today's session as we're talking about the special issue debt deal done and what does it mean? What are the conditions? We did get a ministerial statement that speaks to that. So I'm going to take you through three components of all of this, Vernon, or two main components. One is what were the stipulations? There were three things that were talked about yesterday. One, what were the terms? Two, what are the potential benefits? And three, what are the next steps that our government and our country has to execute? And then I'm also going to talk about what this means from a macroeconomic perspective. And I'm going to use the last debt deal or the last debt treatment as a baseline of what to expect in terms of the outcomes going forward. So remember, I'm just going to try and use a little bit of a mirror effect here. So you really want to take question here, but I have put out my pulse question for the day for everybody. And yes, that I've said that. Are you feeling optimistic about your economic future, your personal one, over the next 5 to 10 years? Are you feeling optimistic in terms of it? That is a question that I want to pose out to people. Are you feeling optimistic? Anyway, now going forward, let's get into today's mainstream conversation. We have gotten a few answers. Now we'll play out some of the other ones today as to what people are saying. But let's get into the special issue today, Vernon, of debt deal details of what does it mean and what has been said. So there was some things that the minister did read out his statement yesterday, and we're going to read out some of the conditions that have been laid out. Bilateral creditors deal, and here are some of the conditions. Maturities have been extended out to almost 12 years up until 2043. It appears China does feel more comfortable extending maturities and stretching them out, lowering interest rates than lowering the amount owed. So that seems to be Beijing's main strategy, to extend maturities as opposed to just straight off principal haircuts. Concessional interest rates of around 1%, that's what has been reported, not exactly stipulated, until about 2037. And then the maximum interest rate from there is 2.5%. That is what we call the baseline scenario. And principal repayments of only 0.5% from 2026 all the way up to 2035. Now, that's quite important. That means that Zambia will only be paying the 1% interest and 0.5% of the principal amount to be repaid, which is currently about 6.3 of the principal amount to be repaid. That is what Zambia will be paying back, leaving us with a much lower burden to repay across the period of the loan. So these are three main conditions. In other words, debt repayments have been prolonged. The repayment period has been prolonged for a longer stretch of time. Interest rates have been reduced to concessional levels of the same amounts that we get possibly from the IMF and the World Bank. These concessional rates about 0.5%, but we're getting them about 1%, and maximum interest rates of 2.5% thereafter. And principal repayments for the first 10 years of us making them of only 0.5%. So really, we're only being asked to pay about 5% of the principal back in the first 10 years, and the 95% will be paid back in the preceding period of 2035 all the way up to 2043. Now, however, there is something called a speed up and an adjustment mechanism where if the economic conditions of Zambia improve, maturities will be brought forward from 2043 to 2038. So there is a 5-year speed up mechanism should our economic conditions improve, where our GDP grows, our situation improves, all these things. That is what has been stated as well. Interest rates will potentially be raised. Now, for all people who are treasury bill and bond investors who have been slightly concerned because of news that they saw in Ghana, which ended up messing things up for them, is that local bond holders will not be included in debt treatment. So if you're holding 10-year bonds, if you're holding 5-year bonds, if you're holding government bonds, treasury bills, you are not included in this. Okay, there is no haircut. There is no stretched principal. There is nothing. You are going on as you were because the case was being made for financial stability as one of the more important factors. So today, I think one of the things we all have to breathe a sigh of relief is for those of you who are bond investors, nothing was going to occur to you. Already, the IMF made it pretty clear that they knew that would destabilize the banking sector and they didn't want to do that because they're trying to get as much capital out to the small business sector. Now, as I said, this adjustment mechanism has also been quite good news for the private creditors because they do want an upside situation that should Zambia's economy grow. So should Zambia's economy grow as projected in 2026. Now, 2026 onwards, we are expecting the economy to pick up very strong. One, copper prices are expected to be up. The copper mines are expected to then start pushing up their output. That's what is expected to take place. At the same time, we're no more importing fertilizer. We're internally producing fertilizer as a country. That's what we're expecting to see. So that should also help with yields coming up and also costs of fertilizer also coming down and also strengthening of the kwacha. And I'll talk about that coming very soon. But this is what we call the tick up mechanism. The adjustment mechanism will be that if our debt capacity moves from weak to moderate, in that our economy, our GDP to debt ratios start to improve, maturities will be brought forward. Now, the first assessment will be done jointly by the World Bank, the IMF, and also the creditors as well around 2026. There'll be an assessment done in 2026 also as of that. So I think they're trying to time to see if Zambia will pick up the pace very soon. But for these years, while we're trying to remold and recover ourselves. So what are the benefits of this? One, reduced repayment outflows for the first 10 years. Zambia was meant to be paying back $6.3 billion. Billion, people. Billion. We were supposed to come up with $6.3 billion to repay people over the first 10-year period. So over these next 10 years, that amount has been reduced to $750 million. That is an 88% reduction, people. In other words, and also what we've seen is that the stretched maturities plus reduced interest rates, sorry, we're going to miss that, is actually equal to a 40% reduction in the debt burden of the country. So this has actually reduced the debt burden of the country by 40% effectively. So Zambia is going to be parting with about $750 million a year, which is much less. If you convert that into kwacha and look at if you convert that into kwacha and you look at our budget, that's less than about 15 billion kwacha that's supposed to be going out on an annual basis from our budget, giving us a lot more fiscal room. And on top of that, sorry, that's not per year. That's over the next 10 years. So you're actually seeing an amount probably around 1.5 billion kwacha going to bilateral debt servicing now, which is much lower than was expected. So this actually helps the country pretty well. $750 million over the next 10 years translates to about $75 million a year, multiplied out by, let's say, a maximum of 20, although we're looking at probably 16, somewhere between 1 to $1.5 billion, billion kwacha is what's expected to be used for debt servicing. Now, the good thing is that we have mineral taxes that are somewhere in the region of $720 million, all the way out to about $1.2 billion as of now. We're not even talking about the case of improved copper output and improved copper prices. Those are the two strong upsides. We're currently at depressed prices and depressed output. So at depressed output and depressed prices, this price that we're paying on bilateral debt for the first 10 years is still only 5 to 10% of mining taxes, meaning the government and the central bank will not have to go into the market to be paying off debt. They don't have to go into the market to pay off debt. They can actually consider waiting for their mining taxes to be able to do that, to be able to offset and make the payments on that, and also the net inflow. So already the first two benefits we can see is that the government will be less on the market for dollars, meaning that actually gives more room for trade to actually improve, and also for the government to sell dollars into the market and to remain in a selling position of dollars onto the market. So these first 10 years, an 88% reduction on the government's need for dollars to be paying debt. That's a huge burden, people, that has been lifted off this country. That is equal. You remember that this $6 billion we were supposed to be paying in these years is equal to probably half our oil bill. So that shows you how detrimental debt was, and that the government actually all this time has been in the market buying up currencies also to try and pay off debt. And that's also what squeezes the FX rate higher. So there'll be less pressure on the kwacha from the government not demanding as many kwachas for these first 10 years of this period. And over the period, obviously, debt servicing has been done. So think about it even on a personal level, Vernon. If somebody was to stretch out your debt, your debt payments, give you a grace period, give you a lower interest rate, you'd feel a lot more breathing room in your personal budget. And therefore, you would have more capacity to do things like build wealth, invest in yourself to grow your income. You can actually say, okay, let me take up that course that I could use. Maybe let me do my master's so that I can improve my earnings capacity and then eventually pay off my debt faster. So these are things that you can actually speed up and do as well. So these are the two of the main benefits. And one, like I said, overall debt burdens will have reduced by about 40%. So instead of doing a principal haircut, they've stretched it out and reduced the interest rates. Other things also is that it's unlocked $188 million from the IMF, which is supposed to be coming in, and $75 million from the World Bank, and reduced annual debt servicing costs. Remember, I said bilateral on the budget, you'll start seeing that only $1.5 billion kwacha, per year will be needed for bilateral debt servicing on an average. So even on our budget, you'll see a lot less money going to debt servicing and a lot more, and especially external debt servicing. A lot less money going to external debt servicing and a lot more money going to productive parts of the economy, be it schools, be it infrastructure, whatever is needed to improve the economic growth spectrum of this country, and also to go into stimulus proportions, whether it's CDF activity, whatever it is, but more money can get to the actual economy rather than money going towards debt servicing. Also, cooperating partner support is actually higher than debt servicing. So the money that's expected to come in from places like the World Bank and the IMF is actually going to be higher. Now, part of what you also need to remember is that we're also going to need to pay back the IMF at some point, people. That $1.3 billion also has to be paid back. So that's $130 million that we're going to be adding to the bill later on as well. Remember, after these first 5 years, you've got 10 years also. Now you have to start paying back the IMF that $1.3 billion. So remember, and this is what China was busy talking about, you want us to be receiving 75, and these guys are going to be receiving more than us. So this is what their sticking point has been. But effectively, just remember, somewhere after these first 5 years, you go from only paying about 75 million to probably about somewhere around 200 million in bilateral and multilateral debt servicing, which is going to be happening over a period of time. $200 million somewhere around the region of 2028. So this is giving you room, okay, lots of room to run and try and improve things for yourself. So that's the second benefit. Third benefit is FX stability is expected. We're expected to switch from we're expected to switch from a portfolio outflow position to a portfolio inflow. In other words, offshore investors who have been and I think there was an estimate of about $800 million of externalization has been happening in terms of foreign investors who have been holding government bonds and treasury bills and selling them off and then exiting the market. So now what is expected to come out is the higher confidence in because of our balance sheet and our debt position and our debt payments and our fiscal room. There is now the expectation that they say, okay, now these guys are capable of repaying their bonds much easier. So let's go back in and start buying up these bonds now. And that's what the offshore investor community now will start to do. And that'll also help. And also it helps attract FDI as well, having a better fiscal position. But remember, we're expected to also have a better rating. So those are the 3 pages of benefits that I will tell you: lower interest rates, lower payments stretched out, lower debt, lower demand from government for dollars. That's a very important thing. Lower demand for government for dollars. That actually helps improve the economic situation for even our currency. Now, other things I also wanted to look at is what are the next steps that are expected? Well, obviously, this is all in principle. This needs to be a signed MOU now. Okay, so they presented the deal to the public. Now it's about signing and officializing it. Also, the government needs to complete $6.8 billion of private creditor negotiations. And also, government is expected to use this fiscal space to start mobilizing resources domestically. In other words, they're expected to ramp up copper production, ramp up a lot of things, and then use growth to now be able to utilize this. That's what we're expected to use. Use our fiscal room and use the growth to now be able to start utilizing, to now start bettering our economic prospects and make better repayments. So that's part of the next steps that have been put aside. And also public debt management. In other words, to make sure that debt going forward requires parliamentary approval, and there must be an annual borrowing plan. No one should wake up in the morning, stick their thumb in there and say, how much should we borrow today? No. People should only contract debt. In fact, I venture to say, Vernon, we're not going far enough in this area. I'm gonna pause here. I've once talked about the fact that Switzerland in 2000 saw their government borrowing at outrageous rates. So what they did as a country was they actually passed they had a referendum as the Swiss people, where they said going forward that the government will no longer be allowed to contract debt unless they're no longer to run a deficit budget. So their budget must be in surplus unless there is an economic unless there is a recession. And over the 6 years, they have to pay back that deficit that they contracted. So they've actually started to say, and this is what I think we should be considering as a country. We should be considering taking such measures, you may call it draconian, to restrict the government from deficits even. I don't think, and I'm telling you this, Vernon, the behavior that creates debt is a deficit, even as a person. Okay, the number one reason people go into debt, they'll say, yes, this happened, that happened, spending more than you make. Okay, that is the number one reason people go into debt. Living beyond means. Okay, means being your income, because that is your means. All right. So the question is, if we want to kill off debt, is putting debt ceilings and debt negotiations and debt, it's evident that whoever government comes into power, even if there's a bill in place to restrict lending, they will find a way to maneuver their way around it. And especially, here's the problem I have. Zambia has a tendency of not having a diverse parliament. Parliament is always one specific party. So whichever party comes in next, if you're going to say debt requires parliamentary approval, well, if those people have more than 50% in parliament, and even if they issue a borrowing plan, they're just going to go, yeah, all together, and yeah, and it goes through. So parliament evidently is also, and I'm sorry to say this, parliament is not a trustworthy mechanism due to the partisan nature of Zambia. I'm sorry, people, but it is not. And even within the parties, and parties stand together. Okay, so if that party says we're going to borrow $5 billion this year, you'll just hear next week, and that's it. It's gone. So I don't think a parliamentary approval and a borrowing plan is a strong enough mechanism. I think there must be a restriction, a constitutional restriction. We need to get to the point where it's woven into our constitution that a government cannot run a deficit, at least a primary deficit, unless we are in a recession. And even that, it has to be. So the Swiss referendum, we need to consider that. Now, some people are saying, no, the Swiss referendum is too draconian. Those are the usual pack of socialists who just want money to be spent from the sky that they never earn. I'm not even interested in them. The reality is that government needs to control its spending. Okay? And it needs to spend from revenue, and it needs to make tax decisions. If it's going to try and expand its spending, it's going to have to make decisions to either expand the economy or increase its taxes. But it should not be given the cop-out of just borrowing willy-nilly going forward. I don't think that. So we need to see stronger restrictions than just saying debt has to go through parliament. Because parliament, as we've seen in Zambia, is under the control of whichever president is in office. Because most often, Vernon, the president usually has parliament. And they control parliament from the party office. These are not independent individuals. These are people who vote on party lines. Okay? And that is the problem. So I don't feel comfortable with the idea that debt should be a partisan issue. But there are obviously some other things that we can bring in, but I just think that there has to be a stronger power than parliament that further restricts anyone from doing this again, because this has destroyed this country twice. Debt has destroyed Zambia twice. I don't know what your thoughts are, Vernon, on whether parliament is a strong enough measure. I don't know if we can finally have you back, or if we're still having technical issues.
Can you hear me now?
Yes, we can.
Okay. So in that regard, I think, sorry, are you getting some feedback?
Yeah.
All right.
Okay. I don't know when you're ready, but anyway, continue.
We're good? You can hear me now? Okay, yeah. So in that thought, I think when you try to think about parliament, of course, that is a team. They are not teams, of course, and it's good to know that they are they are. I think primarily what they want is a good thing, but also having a sense of competition and a second narrative or second thought is always prudent. So that there's always that different angle and perspective whenever you're trying to tackle matters. But in a scenario where we are all party blue, we are all party red, and whatnot, we are going to agree and just say, yeah, please pass it, because at the end of the day, if the Ministry of Agriculture, goes through with a particular program and their money is released, somehow transport and logistics will also have a bit of, some funding in a way or two that, you also build infrastructure, you also push for your own projects as well in your ministry. At the end of the day, your ministry is also doing something. So ultimately, having another thought or another, a second party or so, and I think some of these, social, political parties actually are also, on the table. I have read some of their, criticism. Some of them are quite objective that you want to take on the table and, just see how you can analyze and, make sense of it at the end of the day. I know there are some pretty much sounds like mediocre, does not absolutely no constructiveness in the kind of criticism, but there are some that you can pretty much table and see how you can marry them with
Vernon,
what you have.
just one thing, Vernon. What I was trying to say is that, do you think that it should be Parliament that should be approving debt, or should it be something written into our constitution? Because that's the question I'm trying to say here. Should we, because evidently allowing this to Parliament has allowed us to borrow silly levels before, where we've gotten out of debt and gotten back into debt. President Mwanawasa negotiated us out of $6 billion of debt. We are back in the hole over 13 billion. Okay, double what was negotiated out of. Remember, the Bible says that when a demon goes away, it comes back 7 times with 7 friends. That's what our debt did. It was a demon that went and came back with 7 friends. Okay, that's what ended up happening. So should we, and part of it was to the point where the government was running budget overruns where they were spending more than taxes, 70%. Okay, the spending was 70% higher than the taxes that they were earning. So the question, Vernon, at some point, this has got to some point, but they comfortably stayed 50%. Vernon, if you as a person spend 50% more than your income every single month, it's a countdown till you go bankrupt. So the question I'm trying to pose here is, should we be trusting that, because this bill, the measure is that the president must see cabinet and parliamentary approval for debt. Okay, the economic management team must seek parliamentary approval. In other words, bringing it into the public. And 2, the second thing is that obviously a borrowing plan has to be stipulated. My question is that a strong enough mechanism, or should it be a constitutional issue in this country that you are under no circumstances allowed to run a deficit budget, okay, where you are spending more than tax revenue without us being in a recession? That's a question I think we need to ask ourselves as a country. But that's what I'm asking. What are your thoughts on, should it be the parliament, who we know will just vote in line with the president, whoever that will be, and whichever party is in charge, or should we have something strictly in our constitution which requires a 2/3 majority, which requires a 75% number to overturn a bigger number? Because acts just require 50%. We need something much stronger that requires a majority of parliament. A super majority of parliament, not just a simple one, a super majority of parliament to be able to now overturn it. That's what I'm asking. What are your thoughts on that?
Quite evidently, we've seen how the letting parliament, do the deciding has led us so far, and it is just but wise if you have made a mistake, and you've made a mistake over and over again. You definitely need to just go back on the drawing board and re-strategize things back and forth. If a mechanism that you consistently are using is not working, or rather is working against you, clearly, evidently, numbers never lie. You just but have to, reset a few things, reshuffle. And I know change may, people of course may resist to change, but if it's for the greater good, take it. My thoughts on that.
No, it's true. This is what I was just trying to say. Is that's why I'm thinking on this one. I think I know Western nations are not friendly to this because they don't abide by it, but you do see that deficit spending in Germany is controlled by certain measures. Sweden is controlled by, so there are measures that are woven into their public debt management system, which don't control, because I don't think debt ceilings work. I honestly do not think, even in America, debt ceilings do not work. It's deficit controls. So there must be a budgetary deficit control, because by the time you're contracting debt, already the deeper problem, Vernon, is you're spending more than you're making. Already by the time you're contracting a debt. So why are we only attacking the upper problem, the symptom, instead of the sickness? Because this is the problem. The sickness is deficit budgets. Okay, so why are we not making sure that, can we start to make it very strict that budget deficits need to be based on a specific condition? Are we in a recession as a country? If the answer is no, then the Minister of Finance should only be allowed to present a primary surplus budget, meaning that if you remove debt, external debt payments, and if you remove anything else and you just have the clean budget as it is, the operations and the expenses of the budget, tax inflows, revenues and expenses, if you just have these parts and you're looking at it and saying, are we spending more than we're making, then that should be the main thing. Primary deficits should be abolished as much as possible to prevent this country from ever getting into unsustainable debt, because I don't think we have the self-control, okay, as a nation and specifically as our political class, to just stop borrowing. Okay, if when given the option, people just borrow. Okay, this is the problem. I don't think debt ceilings are a good thing. Not even the Western countries have proven debt ceilings can be controlled, because politicians are people pleasers by nature. Okay, it's taken these guys a lot of political capital to make unpopular decisions where others would have folded on the spot when people would have cried at them. So I really think that this is an issue that we all need to deal with, and we'll deal with some of the questions. I think we have some thoughts here that are coming up from some of our viewers here. Walia Kangwa said, should be both. Parliament should approve up to a certain small debt ceiling, and beyond that, it should be a constitutional limit. That's fair. That's a fair way of looking at it. The other thing is, it's a constitutional issue. We first of all need strip some powers from the president. True, as in this actually does, and this is what we're actually saying. You've got to reduce some of the powers to be able to borrow. Like, you literally have to hold. You know why I'm saying this, Vernon? Debt is a critical issue to the development of Zambia. It has been the Achilles heel of this country. Okay. Debt has been the thing that has killed the prospects of this country twice and sent us into tailspins twice. So evidently, this is a real serious issue that I think has no longer reached bill and act status. I think it's now reached at the foundations of this country legally now. It's no longer an issue where you can entrust any politician any longer to manage the future prospects of this country alone. Yes, I think, yes, give Parliament a little bit of wiggle room, but I honestly think that the majority of the power should be held by the Constitution to say, no borrowing allowed. So that if a Minister of Finance comes in and says, I'm going to spend 120 billion, but we're only raising taxes of 90 billion, then we should be able to say that's an unconstitutional budget. That's what we should be able to do, because deficit control is a serious issue. If we don't control the deficits, by the time you're trying to control the debt, and by the time your budget has reached the debt ceiling, deficits are already deeply entrenched into the system. So if you kill off the deficit, the first thing, I think, is that Dave Ramsey says this. Dave Ramsey, whenever he's talking to people and they're asking him, now, how do I get out of debt? He says the first thing you need to do is to stop contracting it. Stop contracting new debt. That's the first step you need to do. So in other words, you need to start living on a budget where whatever you make and whatever you spend, there is a surplus, because that's what we're going to use to pay down debt. So if these are principles that are held at personal level, why do we skip these at parliamentary level? Okay? Why do these things not matter at parliamentary level? Okay? I'm not saying that. I understand there's certain factors that are outside the spectrum. But I think that if you can really limit the government's borrowing to a need to basis, there's a lot more capital that gets squirted out. As a result, by the way, when Switzerland did this, when you look at the actual debt, the debt control they did constitutionally, they found their economic growth was stronger. They found their job market got built more robustly. They found their lending rate started to come down really strong because there was less government borrowing and the government had to rely on taxes. And the government relied on stimulating the business society in order to obtain its taxes. Could this be the way we should be looking at things? That's another conversation. So I was just really pinpointing on this one about public debt management, where I keep thinking, are we just kicking the can down the road when the next wild socialist pitches up and decides that they're going to promise people chickens in their backyards? We're going to end up now paying the bill for all of this because that person will have 2/3 of parliament, or they'll have 50-60% of parliament like the last people had, where somebody had 60% of parliament, decided to everything through, and all of a sudden somebody borrowed $6 billion without anyone blinking. Okay, no, as in this was a situation we didn't even understand. How quickly did we contract this debt? It got contracted so quickly because somebody has control of parliament. What are you going to do? Even if you had this bill in power, he had the votes. He had the votes to pass it through. Edgar Lungu was the president who had passed the most bills, by the way, than any other president because he had a 50% control all the way through. Okay, he was able to pass any bill he wanted, anything, because he was using party power the whole way through. So evidently it shows parliament is not a safe control. It is not a safe control because it can be hijacked by the political process. Yes, the constitution can be, but that's a harder win that someone has to have. But parliament just requires 50+1 right there inside parliament. And now you can change the course of this country as freely as you want. Okay, that's a reality. Now, so I want to take a look, also, Vernon, on the other side of this, whenever we're looking at this debt conversation, is what were the macroeconomic events or what were the other macroeconomics of the previous debt deal? Okay, so I'm going to take a look at 2004 to 2013. Now, I have showed these things yesterday and I showed them last week, and I just wanted to show you some of them from the perspectives of the whole. I think some of you will know me as an economic historian. Okay, so I want to show it to you from a full-fledged perspective. So I'm going through this as a real issue because this is the core issue that's affecting this country at the moment. So if you look at 2024, and I've gone as far back, people, as post-independence. So I've looked at the size of the Zambian economy, the annual growth rate of the Zambian economy from 1964 all the way, and I've taken it in 10-year batches. Okay. So if you take a look, the last time we got debt treatment, 2004 to 2013, you can see that post-debt restructuring, the economy was growing at a rate of 20.38% a year. The only time that actually was beaten out was post-independence, when we had no debt. Have you noticed, Vernon, when there's no debt, this country actually grows? Okay, but the moment we started contracting debt in 1974 to 1983, all the way through, do you notice that economic growth started to have a problem? The moment we stifled debt between 94 to 2003, growth started to pick back up again. The moment the debt was relieved, 2004, rip. Take a look at that. The economy shoots up 20% a year, okay, in terms of economic growth. So this was the economic size in dollars. 2013 to 2022, Vernon, we start contracting debt. Take a look at what happens now. You see, this is what we mean. The moment we start contracting debt again, the economy gets squashed down to the lowest ever decade of economic growth in dollars. The lowest ever decade of economic size growth in dollars annually. So if you notice, one of the things we should expect from a debt treatment now is rapid economic growth. Okay, that is one of the expectations, obviously, to line up with also the global transition to EVs, the global transition to green energy, but rapid economic growth. So this is telling you that post-debt restructuring, in times where Zambia has no debt, we are scheduled to see double-digit growth of the Zambian economy. Do you see where we're coming from here? Because a stronger currency, stronger economic output. Now, if we look at it in terms of real GDP, actual productive activity, now I'll put this in terms of real GDP terms. If you take a look at it again, After Zambia got independence, the GDP was growing at about 4.5%. Over history, Zambia's economy has grown 3.8% because of these debt downturns. But if you take a look at the two strongest points, post-independence, post-debt restructuring, what are we seeing? GDP 4.5% post-debt restructuring. But if you take a look at post-independence, post-debt restructuring, 7.6% GDP growth. This is a number that we extracted from the World Bank database. And what we found is that Zambia's economy grows much stronger when there is no debt. So what do we expect? Or when there is no debt or low debt, okay? No debt or low debt. So now that we've restructured our debt and the debt burden comes down drastically, what do we start seeing, Vernon? We are expecting to see real economic activity in Zambia should pick up. So this is another expectation that you should have. One, the dollar size of the economy should pick up quite strongly, but also the real activity, the more productivity of the economy should pick up. Let's also take a look at our FX rate, okay? If we're looking at the appreciation and the depreciation of the kwacha, take a look at that. On average, the Zambian kwacha loses 12.3% since independence. That's how badly we've been performing over the period. Since independence, the Zambian currency has been losing 12.3% a year. But take a look at the two strongest points when the currency was its strongest. 1964 to 1973 was a different circumstance because the kwacha and the pound were pegged together at one point. And at that time, there were no free-flowing currencies. So there was a special circumstance that led to the kwacha appreciating over that time because it was still for over 9 years. But if you fast forward, Vernon, 1974 to 1983, kwacha loses 6% a year. 1984 to 1993, the kwacha is losing 40% a year. 94 to 2003, it's losing 20%. When debt is serviced, take a look at that. When debt is relieved, what do we see? The kwacha was barely losing value, only losing 0.5% a year. Barely losing any value. And the moment we started contracting debt again, 10% loss on the kwacha annually again. So what does that tell you, Vernon? When there is low to no debt, we expect the currency to remain strong. So expect a stable kwacha. Some of the things you should be looking at also in this period, which should project an FX market that should remain strong, is one, you've got a ZCCM royalty deal where you're now getting an extra 3% from Kansanshi, and 88% reduction on bilateral debt outflows, which are now equal to 5 to 10% of mining tax. So the government can pay its bilateral debts from its mining taxes. It doesn't need to buy dollars anymore. It's already got them sitting in its own account. From 2025 onwards, there'll be no more fertilizer inputs, or at least reduced fertilizer inputs, which used to equal $300 to $600 million of outflows. And 2026 to 2029, we're seeing a structural reduction in oil price importation costs from the Namibia pipeline and from the Angolan refinery, which should be there. These are four expectations that we should be having of a stronger currency, mixed with the fact that we're not paying debt anymore. And we're not even talking about the other part of it. What are we also seeing, Vernon? From 1971, we saw that the only period of single-digit inflation in this country's history, consistent single-digit inflation. Do you know that for 20 years, from 1984 up to 2006, for 22 years, Zambia had never experienced single-digit inflation? From 1982, to 2006, 24 years, Zambia had not experienced single-digit inflation. The 9% single-digit inflation of 2006 was the first one in 24 years. So what are we seeing? When there's debt, our inflation levels start to rise as well. When there is low to no debt, we start to see stability in prices. As we're crying about the price of things constantly going up, what do you have to fix? You have to fix debt to be able to fix that. Okay, so that's the other part of it. And if you take a look at even the equations of it, you'll start to see that the lowest point of inflation in Zambian history since 1969 was the 2009 to 2013. This is the 5-year spectrum. So 2009 was the first decade of average single-digit inflation. 2009 was the first 2009 to 2019 was the first decade Zambia ever exhibited of single-digit average inflation since 1964 to 1973. That is the first time that this country ever saw that. And also we saw commercial lending rates coming down the last time. So that's what we're expecting, lower interest rates. So, and also FDI, as you can see, rocketed up the last time. The expectation is higher levels of FDI. So I think these were some of the main issues that I've pointed out from a macroeconomic perspective, which we wanted to get some people to take a look at. Just quickly, one piece of news which actually is coming up here, is that Zambia's bondholders also see debt restructuring coming in the coming weeks. This is an article from Reuters. The fact that we have official sector deal is a real positive, said Kevin Daly from Aberdeen, which is part of the committee of bondholders, which hold about $3 billion worth of debt. One reason for optimism in last week is that we saw the government pledge to speed up its repayments if the economy performs well enough. So that's what that ramp up mechanism is for. This is what they've said. They've said they're okay with the principal haircut. And they said other measures is they're accepting and they want an acceptable level of coupons, a realistic duration, somewhere that could be around 10%, and some step-up mechanism of repayment over time should economic conditions improve. Other news that we've also seen is that China's nod to Zambia raises hopes of emerging markets. China is basically owed $130 billion, estimates the World Bank, 77 billion of which is coming from Africa. And this is the first win of the common framework. The Eurobonds, even the Eurobonds issued by Pakistan, have rallied 7% since Zambia's deal was announced. As you can see, Pakistan and Angola are two of the biggest people who are holding China's debt pile. So those are some of the biggest renegotiations expected. But part of the story also reads that Beijing has typically preferred lengthy extensions on debt and resisted reduction in outstanding principal. And the agreement could also help other developing nations now more quickly deal with their debt and also help sell China on the virtues of multilateralism, so regionalism and the threat it brings may finally be reducing. And I think that's where I'm going to kind of wrap things up today due to time and the fact that we went deep into the issue. We asked one question today: are you feeling confident about the economic future over the next 5 to 10 years? Two answers we've gotten so far is kind of, but we need to see how things unfold in the next 3 years. And another one that we've gotten from Kondwani is anxious and optimistic. I also have my own part to play, but the politicians have done, despite what the politicians have done. So that is where we're leaving it today. Vernon, I don't know if you have any final thoughts before we bridge off. And we've given, I think we've flogged this horse on what this debt deal means and what it has.
Yeah, I think essentially there has been a lot of speculation about the debt restructuring from many parts of the country. And I think just giving a clear perspective and path, actually, we have done justice on that today, and we should have even more, a clear, thoughts from people, and as well as, activities moving forward, as they were, they were kind of getting used to the fluctuation of the, kwacha back and forth. But I think with the shared sentiments and direction and factual news given to them, I think we should be on a clear path moving forward, especially for people in the business world, entrepreneurs, investors. I think this should be very helpful moving forward.
Okay. So I think one of the things we should actually now note for everybody is thank you for the questions and answers you've put. I think there's one last comment I'll just read out very quickly from Mick Chikwamo. Said, very insightful. I appreciate the data that you have provided. What we have is poor use of debt funds. Yes, absolutely. There should be a mechanism to monitor the use of debt funds, and people should be held accountable. The use of such debt funds should be audited separately. However, debt itself is not bad. Several research on Zambia indicates that it actually leads to economic growth, only that the growth happens with a lag, and what is needed is more legislation on debt. Look, Mick, I understand, and I understand the logic behind the fact that debt is useful, but the reality is that people are not trustworthy with debt. Human beings are corrupt. That is the problem with us, is that we also have to remember is that politicians are not Jesus. They're humans. They are corrupt by nature because human beings are corrupt by nature. Okay? And all of a sudden, if you give humans access to power, they will abuse it. So we need to limit the access to power. My only issue, and I think Vernon, sorry to lag on this point, is that I think you shouldn't even give it to them in the first place, because it is just a human being you are dealing with, and it's too much temptation, okay, to misuse that money and to just mess it up from the beginning. Yes, you can get one good politician once in a while, but I'm telling you, you're going to go through 5-6 bad ones each time. And yes, it may result in a lag, but the damage that gets done before that economic growth kicks in, there's a huge amount of damage that gets done with the way that we borrow and the way that we misuse the money. So if evidently our people cannot use money correctly, I'm sorry, waiting for them to mature to a point where they can, it's a dangerous one. And I know everyone is saying debt is good. I get it. Everyone has the consensus that debt is good if used well. That is a big if, and there is no control on how to get it used well, except voting the right person in who will promise you one thing when they're being elected, and then when they get in, they'll turn this way and start borrowing through the seams. That's the problem I have. There's no way to control a politician who's in office. That's the problem. You can't control them once they're in. You can only control them at elections. You can't control them in. I'll leave it there. I'll leave it there.
Thank you. You have a good one.
Cheers.